Hey everyone. AT&T stock has been an attractive choice for passive income investors because of that high dividend yield, that robust dividend yield that it offers. But is AT&T stock a buy for 2024? That's the question I want to answer in this video, looking at AT&T's revenue, its dividend yield, its cash flow, its profitability, its valuation, and its long-term debt, putting it all together and coming up with the conclusion, answering if it's a good investment for passive income investors in 2024. So let's get right into it, start digging into the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So in 2023, AT&T stock has had an interesting year, starting on the downward path, being down almost 30% in the first half of the year before recovering in the second half of the year to end at right now, as of this recording, on December 12th, it's down 11% on the year. So that's something that passive income investors have to consider. I know the dividend yield is attractive, but what good is it if you get 7% on the dividend yield, which we'll look at a little bit later, but then the stock price goes down by 11%. So you've lost more than what you've gained in the dividend yield. So that's why we're going to look at the whole company and not just the dividend yield to answer if I think that AT&T stock is an excellent stock to buy for 2024. Starting with a look at its revenue over the trailing 12 months. Now, AT&T has made some major divestitures over the last few years. That's why you see its business falling from revenue of 180 billion down to 121 billion. It divested large parts of its business, notably the direct TV segment, and so that shrunk the total revenue, total assets, and so now it's down at 121 billion. Looking over at its prospects for the next year and the next decade, it's reasonable to expect revenue to be relatively flat for AT&T. It's operating in a saturated market, right, in broadband internet and wireless connections, and some still has some exposure to the TV business, notably in Mexico. But for the most part, it's in a saturated market and markets that are not growing fast. And so the revenue growth is going to be muted for AT&T over the next decade. Now, that's okay. That's just the kind of business it's in. Another thing for AT&T's revenue is that it's in a sticky business. Customers stick around. They don't cancel their subscriptions and switch. It's hard to switch your phone service. And so over 99% of AT&T's customers stay with AT&T month over month. So those are the things you need to consider for AT&T revenue going forward. It's not going to grow quickly, but it's also not going to shrink quickly unless there's a divestiture like AT&T made in recent years. I mentioned already AT&T robust dividend yield, 6.77% dividend yield as of this recording. That's attractive for passive income investors looking to build that passive income stream, right? Every quarter, every 6 months, every year, you're getting that dividend stream from AT&T, and that could really help either save for retirement or to generate income during retirement. Whatever your use case for this passive income, it's helpful that it's throwing off a nice yield every quarter, every half year, every year. The next thing I wanted to highlight is AT&T's excellent and growing operating profit margin, 20% operating profit margin in the most recent trailing 12 months. And that's been rising from the bottom of about 10% around 2016. AT&T has done a good job divesting in non-core businesses, improving profitability, cutting costs, and thereby increasing its operating profit margin. And I would suspect this to continue over the next year. The company has made more cuts. It's planning to save billions on the bottom line. And so that's helping boost the company's profitability in the near term. Similar story with AT&T's cash flow from operations in the trailing 12 months, $37 billion in cash flow from operations in the trailing 12 months. And it's been about this number going back a decade, it increased all the way up to 50 billion at one point before falling down to 32 billion, but it's been up and down around this range for the better part of the last decade. The main fluctuations in cash flow from operations for AT&T has been around the upgrade cycle and been around the cyclical ups and downs of the inventory, and that's built and decreased its cash flow from operations. The big question mark and the big risk for AT&T is the long-term debt. $138 billion in long-term debt and only $7.5 billion in cash. This long-term debt is massive, but when compared to the cash flow from operations of around $30 billion annually, it makes this long-term debt more serviceable. It makes it so that AT&T can pay the interest payments and the principal payments of the long-term debt when they come due. Most of this long-term debt is not coming due anytime in the near term. I have a video out that you may have already seen. If not, I'll link to it at the end of this video that highlights most of this debt is not coming due for several years in the future, and in only little parts, right? Every couple of years there's a couple of billion that AT&T needs to pay back, and it generates billions of cash flow so that those repayments of principal will not be an issue if the business continues on this trajectory. Now, if AT&T chooses, it can also refinance that debt when it comes due, or it can pay it back in full. That's a choice, that's flexibility that AT&T has. Given its strong cash flow and its strong profitability, lenders will be eager to work with AT&T. They are eager to work with AT&T because they understand the stickiness of its business and the strong cash flow that it generates. So they'd be happy to extend credit terms to AT&T at a reasonable interest rate because it makes lenders money and they can feel relatively confident that AT&T has enough cash to pay them back. And finally, I wanted to look at valuation. AT&T is trading at a forward price to earnings of 6.559. That's a cheap valuation. That's a cheap valuation. That being said, AT&T deserves to sell at a cheap valuation because it's in a saturated market. There is little to no growth in the markets that AT&T operates in. And so investors looking at the situation and seeing little growth are not going to be willing to pay a premium price for AT&T stock. Additionally, the company already has a massive load of debt. And so the combination of the slow growth prospects and the very high debt load has investors, willing to pay this price to earnings ratio for AT&T. But the good news is that the cheap valuation makes it an attractive investment because you're not paying too much for AT&T stock. You're paying a forward price to earnings of 6.5. So it doesn't have to do all that much to give you a solid return on investment. So for those reasons, I would say yes, AT&T stock is a buy for 2024. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.